Welcome to the November 2024 edition of MoneyLetter on Markets. I'm Brian Kelly, publisher of the MoneyLetter. This month we present The Implications of Taxes in Retirement, which is the title of the first episode of our sister company Asset Strategy's new podcast, Assets and Taxes. In this podcast, Managing Director and Senior Financial Consultant Kent Fitzpatrick sits down with Senior Financial Consultant David O'Brien to talk about how taxes have an impact on your retirement. Kent and David dive into the world of 401ks, Medicare, IRAs, Roth conversions, ERISA, Social Security, and more. Thank you for checking out the November edition of MoneyLetter on Markets. The taxes and retirement discussion immediately follows. Remember, if you have any ideas for this feature, contact us by email at service@moneyletter.com. We appreciate you listening to our podcast and look forward to getting together again with you next month.
Thank you for joining us for our next podcast. I'm Kent Fitzpatrick at Asset Strategy, and as we've shared with you before, we create, manage, protect, and distribute wealth. With me today is my colleague, David O'Brien. David, thank you for joining.
Thanks for having me.
David is a CFP, Certified Financial Planner, and also a CAIA, Chartered Alternative Investment Analyst, with over 2 decades of experience in financial advisory space. Today, we're going to talk about a 3-letter word that a lot of people just don't want to talk about, taxes, or tax, T-A-X, right? But I think before Dave and I came into the studio, we were talking offline a little bit about, folks do a great job on the accumulation phase, but they don't think about when I get to retirement, what happens with taxes, what's the impact that has. And since the Tax Cuts and Jobs Act, we have 7 different tax brackets, and I don't think a lot of people understand kind of managing those tax brackets. But just maybe expand on our earlier conversation, Dave, the point you made about the focus on accumulation.
Yeah, Ken, thanks. It's been interesting because things have really changed from generation to generation, and we're seeing now the folks retiring today have very different financial pictures than even folks that were retiring just 10 years ago. Most people don't have traditional pensions anymore. They've accumulated all of their assets generally in qualified plans through their employer or through their small business or SEP plans, IRAs.
The 401k became the new pension.
Exactly. So we don't really think about this, but 401ks weren't really a thing before really the late 80s, early 90s.
Yep.
But pretty much my generation, that's all we know is we assume everyone had 401ks, but that wasn't the case. Actually, IRAs only became into existence in 1978. And the initial contribution limit was only $1,500.
Well, and you think about the timing when mutual funds really became popular. I mean, there's probably a battle between MFS and maybe American funds, what the original date was, but I think it wasn't until the 80s that mutual funds really came into vogue as well as a vehicle to invest those assets.
Yeah, absolutely. It wasn't very common for individuals to have a lot of stock market exposure in, the prior generations. It was really only the wealthy that had exposure to the markets, and that would be in a taxable brokerage account. So IRAs, tax-deferred accounts, weren't really that big of a deal. Most people had their pension, Social Security, and other, maybe rental income or different sources of income. Now we have a generation of folks that are retiring with, 7-figure balances in qualified retirement accounts, and we're starting to realize that can actually have some serious tax implications.
Well, and also with the introduction of Roth not too many years ago, and now with Secure 2.0 bringing the Roth 401k into vogue, that's another interesting tax dilemma. Do I fund pre-tax? Do I fund post-tax? What's the requirements for RMD on one side or not on the other? So there's a lot of complexity. I guess to kind of maybe rapid fire with you a couple of the ideas or topics we were going to cover today, and this is going to seem like an overwhelming list, but between ERISA and IRAs, we already talked about 401ks, we'll touch on Social Security, Medicare, maybe IRMAA, Roth IRAs, and people, do they know about conversions? Everyone says, I make too much money, I can't contribute to a Roth. Well, that's not true. I mean, everyone can make a Roth contribution. It's maybe through a backdoor Roth, or maybe Dave and I will talk about the mega backdoor Roth. But what are tax-smart distribution strategies? QCD, the Qualified Charitable Distribution, legacy, estate planning. So there's a myriad of things that come out of this conversation about understanding tax in retirement. So Dave, maybe let's dive in and let's just talk about maybe the on the surface, what is a retiree? What do they need to be thinking about when they've worked for 30, 40 years? It used to be you get the watch and your like you said, your pension. That was maybe our grandparents' generation, but now they've got accounts all over the place. They the tax people are going to tell them what they need to do with their RMDs or required minimum distribution. But what are some of the things that they should be thinking about in terms of getting organized or getting their arms around their stuff?
That's a good point, Kent. It's gotten much more complicated for today's accumulators, to get ready for retirement. And then you throw on top of that, it gets even more complicated once you're spending down your assets, understanding taxes in retirement. A lot of people don't realize taxes and healthcare are likely your biggest expenses in retirement. So how do you get in front of that? And I think, unfortunately, our industry has done a very poor job of educating clients on tax-smart strategies, making a plan. Most folks are just trying to save as much as they can and accumulate it as much as they can, and assuming the rest will work out down the road. And most financial advisors are happy to just focus on managing the assets for the client. They don't really get into tax planning. Most firms, they don't allow their advisors to talk about tax planning. So there's a big gap out there for people that have problems that they don't even know about. But let's back up. Maybe we'll talk a little bit about just the differences between a Roth IRA and a traditional
Good place to start.
Retirement account. Roth IRAs haven't been around that long. They're relatively new. I think it was 2007 when they were initially came into existence, and have slowly gained popularity. And you mentioned the Secure Act, which was only a few years ago, created a Roth 401k option, which some folks have now through their employee-sponsored retirement plans or employer-sponsored retirement plans. So Roths are becoming more available, but really initially, I'll be the first to admit, I didn't really think it was that big of a deal. You can the difference between a Roth account is you pay taxes today, the assets grow tax deferred, but when you withdraw those assets, you pay zero tax. So it's prepaying your taxes opposed to a traditional IRA account, whereas we get a deduction today, but when those assets come out, they're fully taxable as income. So it can have a really big impact on your retirement income.
Well, and just to add to that too, so I know the requirement is you got to hold it in there for 5 years and at least age 59 and a half. You can always take out your corpus, your principal, without additional tax because that's already taxed dollars.
That's
but all
right.
that accumulation. Now, in our notes that we were talking about earlier, a lot of people just ignore that because they said, what can I put in there? I can put in $7,000. That's not going to grow to much. But I think you got a great example here about just how much that little contribution can compound to. Because I think, as you said, IRAs, regular IRAs started in 1974 at $1,500. Today they're $7,000 in 2024 with a $1,000 catch-up, so $8,000. But walk us through that example because I think it's a real good one.
Yeah, I think what we realize is that some IRA accounts have grown to be pretty significant, even though the contribution limits are relatively small. To your point, so if you just started out back when the IRA account came into existence, and fully funded your account $1,500 back in 1978, and every year the contributions have increased over time, and you just got a 6% return. This is a simple return. We're not talking about any particular investment, but you just got 6% compounded over that length of time. You'd have over $1.2 million in that lowly IRA account that we don't really give a lot of credit to. Now you look today at 401ks, which with much higher contribution limits and employer match potential. We're seeing 401k balances, in the millions of dollars, right? And those are potential tax time bombs for future retirees. So
let's go back to a point we made earlier about people's misconception that I make too much money, I can't contribute to a Roth. Can you just walk us through the basics of what the industry refers to as a backdoor Roth?
Yeah, so you can contribute. Any individual, regardless of income, can contribute to an IRA and have it be a non-deductible contribution.
Regardless of income limit.
Regardless of income limit. You are limited on who can contribute to a Roth. Married filing jointly, I believe, is $90,000. So
Directly.
to a Roth account directly, not a Roth 401k. There's no limits on those. So a lot of folks just don't think about it as an option because they're either making too much money or it's just, they're funding all their retirement through their corporate plan. But you can make a non-deductible IRA contribution and then immediately do what's called a conversion. So you change that from a traditional IRA account to a Roth account. Now, normally, if you had a deductible account, you'd pay taxes on that converted amount. But since we made a non-deductible contribution, that's not taxable. So you just recharacterize that non-deductible IRA into a Roth.
Yep. And you mentioned about the Roth K, and let's just talk about what the 401k limits are and walk the audience through, again, pre and post-tax options within the 401k structure.
Yeah, that's a good point. So you can make, if your employer offers it, which has become more common now, you can elect to make Roth 401k contributions. And the difference is I'm going to pay tax on that money today at whatever your tax rate is. It's not a deductible contribution, but when it comes out down the road, it's tax-free. But why does that matter? That's really the bigger issue. There are a couple of other differences with Roth and versus traditional
pre-tax
IRA accounts or traditional qualified accounts. Exactly. The other is there's no required minimum distributions for a Roth account. And a lot of folks don't think about that because they think that's way off into the future. And actually recently the IRS or the government made a change to when you have to start taking required minimum distributions. Now it's up to 72. It's going to become 73. But at 72, you have to take out at least a portion of your IRA account. The government wants to get their tax money. So you can't defer it indefinitely. Most people will be spending that money down anyways, so it may not be a factor, but somebody that has accumulated a very large balance in a qualified plan, that could really boost the amount that they have to start taking out of their IRA accounts. So it doesn't start out as a big number, but when you get into your 80s, your life expectancy is shorter. That percentage that you have to take out every year climbs to a pretty high number. So what you find, and this is where the problem is becoming more evident today, is we're finding retirees that are in very, very high tax brackets and they have no options because they have to take out those required minimum distributions.
To pay for that healthcare expense that gets larger and larger.
Exactly. So then that also triggers sometimes your Social Security Part B and Part D premiums are impacted by your income. So most people don't think about this. Again, this is something that's way off into the future, but there's something called income-related Medicare adjustment amount. IRMAA, exactly. So much easier to say. But IRMAA is not your friend. And if you make a lot of money in retirement, which again, if you've been a good saver and you've accumulated a fair amount of wealth, you could be paying a significantly higher Medicare premium as a result of that. So it's not a tax, but it sure feels like a tax to me.
Well, it walks like a duck, talks like a duck.
Exactly. It doesn't show up on your tax return. It just gets deducted from the amount you receive in Social Security.
Well, I think a lot of our listeners probably are not familiar that IRMAA is a backwards-looking assessment. So if I'm going to apply for Medicare at 65, they're going to look back to see what your earnings were at age 63 to determine if what that surcharge is going to be on your Part B. We have it in our notes, so you can range from as low as $174 up to almost $600. So it is a big delta, especially for someone who's retired. They don't have earned income anymore, and they're reliant on drawing their income or Social Security benefits. So that's a big penalty.
Yeah, and for a married couple, it's times 2. You each have your own Medicare premiums that you're going to pay, so it doubles. So it can really add up to be a pretty big number. And again, sometimes people just aren't aware and they get caught off guard. That's the worst, is that no one told them.
So if they can manage what that income is at age 63, at least for that look back, that's going to set them up for a more successful or less painful tax potentially with IRMAA.
Yeah, if you have some Roth assets and traditional IRA assets and Social Security, you have different tax buckets that you're able to draw on in retirement. So we can take a certain amount from our IRA accounts. That's going to be taxed as ordinary income. That's going to impact how much we pay or how much our Social Security is taxed. But then that tax-free bucket, the Roth bucket, allows us to manage our tax brackets in retirement, which can be very, very powerful. The problem, as we mentioned before, is if you have all of your assets or substantially all of your assets in fully tax-deferred accounts, and those RMDs keep ticking up over time, you have no control over that. And what you find is you have, retirees, as I said, in their 80s that are paying much higher taxes than they ever thought they would be. Their Medicare is taxed. And also, we haven't touched on it yet, but those assets can be terrible for beneficiaries to inherit.
Yeah, correct. And I think you said it, but I think it's managing that tax distribution strategy. So you talked about tax deductions. There's also tax credits. There's tax-free. So I think it's kind of aligning those strategies and having a projection into what that tax impact's going to be if I don't make some plans before I get to these trigger dates.
Absolutely, and we can run those analysis for folks and actually take a look at, where they are today, what their current tax bracket is, and you can actually do what's called a partial conversion. So if you do have a significantly large IRA, 401k balance, you don't have to convert everything all at once. So what we often will recommend is you have somebody that's in their pre-retirement phase, or maybe they've taken a step back from their full-time job or have a lower earnings for a period of time, or recent retirees, one spouse may be working, the other not. There's a lot of scenarios that may artificially lower your tax bracket 1 year. You can make a conversion up to a certain level, so we call it filling the bracket, and convert only that amount, and then you can do that over multiple years. So it keeps you in a lower tax bracket, but will chip away at the tax problem in the future. And so you don't have to do it all at once, is my point. So having a tax smart strategy, you may implement over 3 to 5 years to significantly convert a significant amount of your traditional IRA assets to Roth that gives you that flexibility in the future.
So it's really bracket management. I think I alluded to that there's 7 brackets, and maybe just for our audience, those brackets are 10, 12, 22, 24, 32, 35, and 37. So, but as Dave said, there's a income, gap, if you will, or a stepping stone before I'm going to pierce into the next higher bracket. So it's that bracket management, I think, is what you're suggesting, that you can really do some smart tax strategies or conversions if that applies.
Absolutely. It's what you pay on that marginal dollar of tax. So your effective rate may be lower because, as people know, our tax brackets are blend or progressive. So you want to just avoid triggering that next higher bracket. But you may have some room in there that we can tell people how much is a smart amount to convert in any given year based on their current income. And as I said, if they go through a transition year, or for one reason or another they have a lower income year, you may be more aggressive with your conversions. And we can...
Or they triggered some losses or whatnot, right?
Yeah, you could have carry forward losses and other things like that. So there's a lot of scenarios where you may be a little bit more aggressive with the conversions, but we want to be smart about it. You don't want to pay more taxes than you need to.
Sure.
And no one likes to prepay taxes, but in some cases that could lower your lifetime tax bill. We may prepay a little bit today, but longer term, when you see that saves you a significant amount of money over time, it can be a very smart strategy.
So, my takeaway is a little planning, a little foresight, a little strategy can go quite a long way.
Absolutely. And as we, let's kind of wind down here, because we certainly can answer anybody's individual questions, and we're available for consultations. Everybody's situation is different, so it may not make sense for everybody. But for a lot of folks out there that have been very diligent and good savers, having too much money in a qualified plan can cause a lot of other unforeseen problems. And we touched very briefly on some of the changes of the Secure 2.0 Act that's a couple years ago. They eliminated the ability for beneficiaries of IRA accounts to what we call stretch them. Prior to the Secure Act, they used to be able to take withdrawals based on your life expectancy. So most beneficiaries are going to be in their hopefully high income years. They could just take out a smaller amount every year and have that tax deferral for their life expectancy. So inheriting an IRA wasn't that big of a tax hit. They don't get a step up in basis, so that's another thing. So they're fully taxable on distribution. Now, post-Secure 2.0, the beneficiaries have to take out all of those assets within 10 years. Now,
whether it's Roth or IRA.
That's correct. Roth isn't going to trigger any taxes to the beneficiary, though. It's really those traditional IRA accounts. Those can be really tax bombs for the beneficiaries.
But here's a point I want to stress that you brought up earlier, the estate tax. I think a lot of people say, well, gee, I've named my kids or grandkids as my beneficiaries, so it's out of my estate, right? Well, no, the Roth, they're going to inherit tax-free. They got to take it out over those 10 years. The IRA, the kids are going to inherit as taxable income. They got to drain it out over 10 years. But what mom or dad didn't realize is that's includable assets in terms of their estate, so it's subject to estate tax.
Correct. And now federal estate taxes are fairly high, so it's not going to impact that many folks. But if we're sitting here in Massachusetts, the state estate tax is only $2 million.
And 16% is the tipping fee.
Is the marginal rate. And what also people don't realize is once you trigger $2 million, it's the whole $2 million that's subject to tax. It's not just the assets above that.
It's retro.
It's retro. There is an exclusion amount, so there you do get a credit, but that's a pretty big hit. So IRA assets that hit a taxable estate, which nowadays, as I said, if these are folks with large balances, they own their home, you know what housing prices are these days, they've got a reasonable amount of assets. You die as a Massachusetts resident, it's a very high possibility that those IRA assets are not only going to be subject to an estate tax, then those distributions are fully taxable to the beneficiary. So it's really a double whammy. So it's become really not a great asset to inherit. So you really want to, Roth actually, on the other hand, you flip that on its head. Roth asset is a great asset to inherit. They come tax-free to the beneficiary. They can hold them tax deferred for 10 years, and when they take it out is fully tax-free. So it really changed the dynamics of the value to the beneficiaries, Roth versus traditional.
So one point I want to talk about before we wrap up here, related to estate planning and legacy planning, is the QCD or qualified charitable distribution. Can you talk to the audience about that?
Yeah, absolutely. A lot of folks don't realize that is an option if you are charitably inclined, right? Mm-hmm. So what most folks realize now is with the unified credit, it's most charitable deductions, especially if you're as a retiree, are likely not going to be deductible.
Yeah.
So yeah, it's not.
Oh, so you're saying about the standard deduction or the personal
correct.
exemption,
They're not going to itemize. Most retirees these days aren't going to be itemizing. Depends. Everyone's situation is different, but more often than not, that's a $5,000 charitable contribution that they're going to make to their church or school or what have you, isn't deductible.
And don't you want to be giving away tax inefficient assets anyhow?
Yeah, so that's a great point. You can do what's called a charitable QCD, charitable qualified deduction, or qualified charitable deduction. Yeah. So you can take assets up to $100,000 directly out of your IRA and make that donation.
Does that satisfy my RMD that year?
It does. So that's a good way, and it doesn't hit your 1040, so you don't have taxable income on that. So it is effectively getting that tax deduction that you missed out on. So it's not taxable income to you. It satisfies your RMD, and the charity gets the full benefit.
Fantastic. Well, Dave, this was really a great conversation. There's obviously a lot of complexity when you're not just in the accumulation years, but you're thinking about the drawdown years. So I would recommend, everyone's situation is different or unique. Don't go it alone. You probably need to talk with an experienced planner, and want to thank you for some of these ideas you shared with the audience today.
Yeah, thanks a lot, Ken. I think it's become more and more complicated with all these different rules changes over time, and I think just there is a gap out there, and there's a lot of folks that just aren't getting this advice, and it's it can really sneak up on you. So pre-planning is really important. So if you're in that kind of retirement red zone, we call it, 60-ish years and older, and you haven't sat down and put together a retirement income plan, you really should. And this is just one facet to it, but having a plan in place to manage your taxes in retirement can really make a huge difference to your overall lifetime income.
Fantastic. Well, thanks again for
Yeah,
this
it's great.
conversation.
Thanks for having me.
All right, thank you.